Hi all, this is Akshat Menon from PMS Bazaar. I am delighted to welcome you to today's webinar on the topic Real Estate in Wealth Creation Harnessing India's Growth Potential. This session is a unique departure from our usual focus on equity markets webinar, and we have an exciting agenda planned for you today. We will explore the tremendous opportunities in India's growing real estate market, driven by factors like urbanization and economic growth. Our discussion will include an analysis of current trends and future predictions in real estate investments, highlighting the key economic indicators and market conditions. We will also look into the benefits and the risk associated with different types of real estate investments, including direct proprietary ownership and financial products. Additionally, we will also cover how real estate investments can play a crucial role in reducing the portfolio risk, enhancing the returns through diversification. Now it's my pleasure to introduce our expert of the day, Mr. Akshat Pandya. With over 20 years of experience in real estate, private equity, investment banking, and constructions and finance, Akshat has led an executive investments exceeding around $350 million dollars and had been involved in transactions over $3 billion. His distinguished career includes roles at Axis Capital, ENAM, Lehman Brothers, HDFC Limited. Akshat holds a master's degree in management studies with a specialization in finance and bachelor degree in commerce from the University of Mumbai. We're excited to have him to share his insights. Over to you, sir.
Thank you, Akshara, and a very warm welcome to everybody. I would like to start off by giving a little brief about how the sector has evolved over the years, because I think it's extremely critical to understand where we are in terms of maturity as a sector, so that accordingly, the relevant risk reward matrix can be applied to the products that are available in the market. To start off, I'd like to, first bring to everybody's notice that the actual real estate funding or the financing sector in India is, just about 20 years old. Very luckily, it coincides with my career. So when I started 20 years ago in India, there were only two, houses that actually had specialized real estate funding teams, which was HDFC and ICICI. All the other institutions and banks used to do funding through their existing credit teams. So from there, in 2005, the sector launched its first real estate private equity fund, again, coincidentally, which was HDFC that did that. And there was the first boom from 2004 to 2007, which saw great, increases in prices, real estate suddenly becoming, the flavor of the day, everybody wanting to take exposure, the first set of real estate developers, being listed. And just to give you an idea, by 2007, at its peak, there were 120 different global funds that had exposure to Indian real estate. All of this, as we all know, came crashing down post the Lehman crisis in 2008. And in the aftermath of the Lehman, or the global financial crisis, as we call it, all central banks started pumping in lots of liquidity, which brought about the second upcycle in the last 20 years. So 2009 to 2012 again saw a very good time for real estate. Again, a second round of real estate companies got listed in that period. Sales were good. The critical part about this upcycle during that period was it was more investor driven. The products that the developers were making at that point in time were more high end, larger apartments, purely because luxury and larger apartments have better margins. So because it was more investor driven, there was a lot of capacity that was built out, which took the country another 6-7 years to absorb, and hence post which the country entered the longest bear run for the real estate sector, which was from 2013 onwards all the way till 2020. I think a few factors during that time which helped in prolonging the bear market for real estate, such as demonetization, the introduction of RERA, GST, the credit crisis in India with the NBFCs facing issues, post a large organization going down in 2018. All of that brought in, besides the bear market, a lot of changes and regulation to the market, and I think it's very critical that I do mention that. So RERA, for example, has actually been a game changer. It has brought in a serious amount of discipline within developers. It has given teeth to the actual home buyer, even though it may be a little lopsided right now in favor of the home buyers. But I think with where the sector was poised, I think it was a very a necessary move. Since then, even with the NBFCs realizing that growth cannot happen out of sync with the rest of the economy, and it has to be measured and in a manner that is sustainable. The lending with high LTVs, lending to name lending to a certain extent, taking undue risk in the form of even debt was all of that came crashing down with 2000 post 2018. And then we've seen three tremendously good years post the COVID, waves. Here, I think the critical part, which all of us need to understand, is that for the first time in this upcycle, the developers are actually making products which are for the end users. These are products that are actually being absorbed by people who want to live in them. And that is very, very critical in the demand being sustainable. So none of the previous upcycles was actually catering to what we call as India's demographic dividend, and that huge population which is your mid income, upper mid income, even to a certain extent the lower mid income segment, where housing is a genuine need and requirement. And for the first time, that is being addressed. Now, during the same period, what also happened as the markets kind of started becoming more organized with all these regulations and changes coming in, is that the investor could start taking exposure across the entire capital stack and the entire chain. I would love to share a slide. I think this would make it a little easier to understand. I hope the slide is visible. So today, I think the sector has evolved that within the sector. So right at the start, early 2000 or the 90s, there was one way to play real estate. You actually buy physical real estate and wait for prices to go up, capital appreciation. From then, 2006, 7, all these funds came in, promising 25, 30% returns, saying we'll take equity risk and ride the wave. The challenge but in designing any product is the predictability of the cash flows that the underlying is going to throw up. And purely because of the inherent nature of real estate in India, which is still a very localized subject, the way real estate works in a going to be different from other cities. Across any sector, if you were to take, I have made this specifically for real estate. Now, here, about 10, 15 years ago, you did not have the ability to make, or invest in products available across the entire range, or the cap stack, as we call it. So now suddenly you do have this. So I'll just quickly run through it again. REITs, today, there are four listed REITs already in the market, which are giving you yields between 5 to 7%. Again, varying, there is some capital appreciation in there as well, and rental escalation, which may push your returns higher. Then come your credit papers. And the reason I've, kind of written banks and NBFCs there is they're the ones also giving this credit out. So as from an industry perspective, that's the range in which lending happens. This lending could be for construction, could be a loan against property, could be, lease rental discounting, all of the lending, but to the sector. Again, here there are rated papers that are listed and are available for investors to take exposure today. And then come the funds. So all the funds, the real estate funds in the country are still, targeting 18 and above. They're ready to take a lot more risk. They're ready to, kind of do specialized strategies in terms of their exposure, and then give those returns or target those returns. But what we have noticed is, within all of this and the evolution, there was this little space which was left out, where not too many large organized houses are coming out with products.
Mm.
So for us, it is an area of focus. That is the strategy we believe is yet to be capitalized on. That is a strategy that we believe can give consistent returns to investors, and we've been taking exposure within this, the dotted circle, and we've had some very good success in that as well. And the idea is, over time, as a sector matures, it needs to start giving consistent returns within the risk profile that it offers products in. 2019. Now, when we start off with the first wave, that's when we saw a real dip in the real estate space, and I think it was linked more to fear of how long this would continue. What were the possibilities on or impact on cash flows, on will properties be built, be delivered? But I think what it also ended up doing is suddenly making the home buyers, or the people that were living on rent, realize that owning a home and that security is something which is very, very critical and a requirement. And hence that massive demand is what followed in between all waves of COVID. It's very evident across some of the larger ways we measure in terms of consumption, GST collection, taxes, your electricity consumption. All of that, we're seeing that we're on a robust growth trajectory. Now, if we were to match this with what we call the shortage or the requirement of housing in the country, which various reports peg it anything between 30 to 40 million units, we're in for a really long run, where if you know how to invest, which segments to take risk to with, you're going to be able to get disproportionate returns compared to any other sector. Now, I think what is critical here to point out is that the sector was cyclical, will remain to be cyclical, and anybody who believes that it is not going to be cyclical is in for a tough ride. So I think the ability to understand that within cycles, what actually changes and what are the new trends which will lead to cycles, because now a couple of things that are happening is that the cycles are no longer across the country. The cycles are becoming city specific, they're becoming micro market specific, they're becoming product specific. For example, in India, the residential cycle and the commercial cycle have always been inversely proportional. So when residential is doing well, commercial is going through a down phase, and vice versa. Similarly, now we've got other avenues within real estate, such as hospitality, retail. We've got the first retail REIT that has been listed. We've got warehousing, which has come up as a new avenue where we're seeing some interest. There are co-living, student living, senior living, all of these new trends that are coming in. And I think the sector is still at a very nascent stage with tremendous amounts of growth potential left. And with all of these trends and the growth that comes in the ability to make returns and to create significant wealth. Now that is where, how do you play the sector, how do you understand the inherent risks and accordingly take exposure. So from a pure let's buy physical real estate to financial products which are more specialized, which take certain well ring fenced structures where the risks are, think, is the way to go forward and to play that this sector. There are trends on how the inventory is growing, your numbers. So I think all the demographic numbers look good. What I would like to personally do, instead of me dwelling into numbers and running through all of this, is actually take on a lot more questions on where everybody feels there are challenges, or if there are doubts, and I can help answer some of those.
So let me start off with the interest rate. Say in changing economy, interest rate changes always happen. So how do you what are the risk mitigation, or how do you employ that into your strategy?
Perfect. So, taking interest rate specific risk, if you look at interest rate risk, we're talking about, if you look at debt paper, especially towards the lower end of the return segment, right? The triple A rated, the double A rated investment grade, wherever you go, that will always be linked to your treasury rates and the interest rate in the industry, because it all operates as what is the risk free rate plus a certain risk premium that you pay depending on your rating as a company. Uh, what's happened in real estate per se, again, if you are going to be taking exposures on the lower end of the segment within the sector, yes, you will be subject to interest rate risks, which is, then you need to be cognizant of where you are in the cycle. So if the rates start going down, you will also benefit from the capital gains part. But if you're caught on the other end of the cycle, you may even end up losing your entire return and then maybe some capital as well. So that will prevail in the lower end of the segment in terms of return. But what's happening on the higher end, and again, the 15 and above is what I'm talking about. Today, the growth has been so phenomenal that the requirement of capital far outstrips the availability of the capital. So the number of capital providers, and that is purely a function of, do people understand the inherent risk to be able to structure products is limited, because everybody and real estate is the sector, I may be digressing a bit, but everybody has an exposure of some sort, and because of which everybody has a view. Now what they do is they extrapolate the view to the entire sector. So they may have bought a property 20 years ago, which might not have been a great experience, or somebody who's bought a property and its value has gone up 10 times has a very different view. But what they need to start now looking at is the actual, the structuring of the products that they're taking exposure to within the sector. So at the higher end, to answer your question specifically, it is not that interest rate sensitive. So because of this anomaly, and which is likely to remain at the higher end, I think the returns can be consistent, uh, because I think we're a long way away from filling that mismatch between the capital required to the available capital. Just to throw some numbers, and certain large houses have come out with reports on this. They are pegging the number at anything between 40 to 60,000 crore of annual mismatch between the funding requirement to the actual funding currently being done. Now, again, obviously, the larger guys get the funding, the smaller guys have trouble, and hence they start raising capital from the unorganized sector, which is more expensive, comes with its own set of challenges.
True. So where was this report, sir, if I could ask?
So there are two reports. I think ANAROC came out with a report in 22, and I think JLL has also recently come out with a report on this, where they're trying to peg. Now, what JLL has done is they've taken I think, a 5-year period and then given the shortfall. ANAROC has done it on an annualized basis.
Because I got to see this Goldman Sachs report recently, so I just want to know that. And talking about the real estate credit as a sector, so when you see there's a trend, so what are the trends that you see in this particular sector now?
Sure. I think the word credit is very loosely used in our industry. People believe that just because the return is fixed, it falls under the ambit of credit, which is technically not the case, right? And I love when we were actually learning the capital structure in financing, uh, the risk of a product is a function of how many people are ahead of you in the cash flow and the predictability of the cash flow. So the credit space, because especially in real estate, people started with equity. In equity, they got burnt because obviously they did not realize that the actual monetization of real estate takes time. And just as an example, I remember in 2007, DLF actually went and bought a land, and immediately the markets gave it value that this land will be built. Take a DCF and present value, and market cap just shot up. Uh, People then started realizing that it takes time to actually build and monetize that land, and hence it's not as simple as an Excel. Again, coming back, people have been using credit in real estate, but the risk inherent has actually been akin to equity. The only difference being that it is a debenture instead of an equity instrument. I think now what's happening, and when you use credit, it means, the term parlance credit, which is used in other sectors, that there is a inbuilt inherent, security structure. There is fallback. There are ways in which the entire thing is ring fenced, that will ensure that the money comes back to a certain degree, and hence, the rating and the actual outcome. So I think that evolution has started. There are now players coming down from the return expectation and making sure that you have products at 17, 16, 15, 14, all of that. And I believe that is the genuine, use of the term credit. And I think we're going to see more and more evolution of that, because if you look on the debt side from an investor's perspective, there aren't too many options where you can actually go over the 13, 14 percent return in hand with reasonable amount of surety, because then
Mm.
the risk goes exponentially high. I
Right.
think this sector, like I said, because of the anomaly, is able to give a delta of 200 to 300 bips over other sectors with the risk akin to lower. So taking 11, 12% risk and then actually delivering 14, 15%, 16% is a possibility in the sector. And that is the beauty where, investors can capitalize and take exposure.
Yeah. And talking about the deals on the trends, how do you see the deals getting its trend in this industry?
So here, first, I'd like to start off with, the change has not only been on the financial, investors or the lenders. I think there has been a drastic change in the developer side as well. I think they've also institutionalized, become more organized. They've realized that if they want, and real estate is an industry which needs constant capital. So they've realized if they need constant capital, there has to be a certain level of discipline, both in terms of product design, delivery. They need sales. They require, at the same time, all their financial partners to also be, happy. So I think all of that entire ecosystem changing is extremely critical. I'm so sorry. The second part, what was the question part?
No, I just wanted to know what are the deals which
Yes, so the deals that are coming today are going to be divided into two separate segments. So the bunch of developers that are organized, like I was saying, who've gone through the entire cycle and realized what they need to deliver, both from a customer and a lender and an investor perspective, are where we are seeing genuine deals, where that it's easy to close. There is meeting of the minds. There is a real deal, as we call it. In terms of a lot of new entrants or people who are still taking money from the unorganized segment, there is still a mismatch between return expectations. I understand that all entrepreneurs need to be optimistic, but their level of optimism and a lender's level of pessimism are right now two separate Venn diagrams that do not intersect.
Got it. And let me take one question. I'll come back to this, but let me take one question from the audience. What is going to be an impact of removal of indexation of option from someone who invests in real estate as an asset class?
Sure. I think the critical part of that is the 2001 date that the government has put, because if that date was not put or it was different, it would have had a massive impact, because are genuinely a lot of people who own real estate which is older than 20, 30, 40, 50 years, where I think indexation is absolutely critical when and if they decide to sell that property and then either buy a new house or redeploy it elsewhere. But because of that date, if you see now, the biggest impact is likely to be, if I correlate this with my first part, where the biggest run up was 2004 to 2007 in terms of real estate prices, in terms of, where people actually made genuine wealth in capital appreciation. So even for those people, if you look at what was the indexation and above that, so the actual price appreciation has been significantly higher than the indexation number post from 2001 to 2024, if you were to look at it. And above that, they had to pay 20% capital gains tax. Now that has come down to 12.5. So, which actually, again, there will be a small period where people will be worse off, but there is a big chunk where people are actually better off in terms of the amount they have to pay. And I think if I correlate this with the other part, I think the government's put a 10 crore limit. But as long as it's being reinvested in real estate again, I think the capital gains, benefit is still, passed on. So I think that will actually aid the real estate sector from the point of view that if and normally somebody sells a house is because either they want to buy a new house or upgrade. There'll be very few, only pure investors who had bought from an investment perspective will end up paying tax. And to that extent, I believe, with the FM's vision of getting every asset class aligned, 12.5%, if you genuinely made that kind of wealth, is not an absurd number.
That's true, sir. I think that question has been briefly answered. And one more question is, why did supply trend curve up post quarter two 2020? Did the buying price go down and why? And need to understand the psychology of the people already owning the home via versus on rent. I think he's talking about the curve that you showed in the PPT.
Yes. So if you see the two dips are only the two waves. So the second wave, which was Delta, which was one of, I think more deadly than the first one in terms of fatality, that is when it's dropped, right? After that, if you see more or less, besides the small third wave in Jan of 22, it's been a consistent upward movement. What we have, like I said, the psychology part that you were asking about, uh, what we have seen is people who are on rent actually went through a lot of challenges from societies across the major metros, and how they were treated, especially during lockdowns, which led to a large chunk of people suddenly saying that we'd rather own a home if we have the means than to live on rent. Uh, I'm hoping that this is the question, right? What led to
Yes.
the psychology of people to start moving towards buying houses?
Yes.
So that was one. The second was people realized that if we need to work from home, you need a separate space where you can actually, work from, which in the Indian context, and especially in cities like Mumbai itself is a challenge, where space is a challenge. So hence the upgrade cycle started, where people started saying that, let me see if, I have the financial means. Why not move from a two to a three, where I have one room where I can work from? And the last was, I think, we're seeing also the nuclearization of families. So, post marriage, the children want to go move, get a house of their own. All of it kind of impacted life is short because of the fact that people saw what COVID can do to your lives. And I think that leap and going ahead and buying property, and hence this whole pent up demand as well because of the longest bear run that we've seen in the sector. So all of these together led to this entire demand inflow that we've seen over the years.
When you talk on the region specific demand, and when you say Mumbai, the space is an issue. So what are the other deal sourcing cities in India?
So, as a strategy, we focus only on the metros, even though the tier twos have seen, a huge jump in terms of, again, all of these parameters, absorptions, which is, so getting into specific cities, I think we've seen that Bangalore is one of the most resilient. Bangalore has, seen consistent absorption and growth, and in all directions of the city. Hyderabad has had one of the best, I think, periods since COVID. The price appreciation, the absorption in both terms of area as well as the quantum is massive. So if you look at it across markets, but I think the underlying psychology is what you need to understand, and this is maybe me generalizing a little bit. The markets up north are a little more investor driven, where people, when they see opportunity, investors come in. The markets down south are a little more traditional, so as to speak, in that aspect, where the real estate investment is to the tune of the space or the home that they want to buy, and then not go ahead and buy a second, third, fourth, fifth, sixth, and try and make a real estate an investment class per se. So because of which the volatility that we see in the prices and in terms of the cycles is a lot lesser in markets where there are lesser investors, but naturally, and because of which. Right now, I think NCR is actually seeing some very good price appreciation. The hike in both land values as well as residential prices is significantly higher than some of the other micro markets. Whereas in markets down south, again barring Hyderabad, again which has been a little more sporadic in this run, we're seeing a more consistent increase in prices. So I think in this run, the general upswing has been across the major metros. Again, quickly touching upon tier twos, even though we don't actively invest in that, I think there also we're seeing a significant uptick in absorption and new developments coming in. My advice to anybody who's looking to invest in tier two cities is that because real estate as an asset class is illiquid, make sure and the growth of a city starts from the center. As long as you're taking exposure to the prime areas in the heart of the city, it is likely to experience larger capital appreciation than on the outskirts, because as the city catches up, again they have a very favorable base effect because the price per square foot is still low. As an example, 5,000 rupee going to a 7,500 rupee a square foot is a greater possibility than a 80,000 rupee a square foot in Mumbai going to 120,000. So that's again a great avenue for investments. But I would request everybody to keep these 2 points in mind: liquidity, and hence make sure that it is in a well-established location in the heart of the city. I think there is a lot of growth all these cities are going to witness.
So the price appreciation is a constant here.
Absolutely.
And one more thing is that the fund's performance depends upon the market's economic cycles as well. So if there's an economic downturn, like what you have, well, the slide which you're showing is 2020.
Yeah.
And those are the very crucial time where you could, that because when you say real estate credit, the credit comes along with, they related to debt. They expect the return, promised returns. Probably at this point of time or 2020, it was not possible. So how was that risk managed, or how did you face it?
So I think understanding the constituents of the risk you are taking is critical. If your product or the exposure that you're taking is dependent on prices going up, so capital appreciation, for example, then you're going to have to time cycles. So if you're at the other end of the cycle, you're going to be hit. There is no exception. If you are going to, design your product such that you're sticking to the development margins, and I think that is something we realize. So because real estate is a complex subject in India, it is not easy yet to, go and become a developer and make your own tower with the approval challenges and all the other challenges in the country. There, what we've realized is that you, if you structure your product from the development margins, the returns can be high and can be consistent. And that is exactly what we advise all our clients and our investors to do, instead of trying to time the markets, because I think everybody is well aware of what happens when you try to time the markets. So the sector is no different, and I think that is why when people make investments, especially on the high yielding side of anything 15 and over, they need to understand inherently what is the risk that the fund manager or the product is taking. Because if that risk is not understood, then, and it is based on timing markets or the cycle or capital appreciation, they are in for a little bit of a surprise by the time they get the money back.
Sure, sir. And let's move to the next question. So you talked about the product specific cycle for the sector. Can you talk a little more about which product are in upcycle or likely to be in upcycle next 2 to 3 years?
And so, because, like I mentioned, real estate, residential, and commercial are always inversely proportional, we're actually seeing an uptick on the commercial side. We are now seeing greater absorption. We're seeing, some rental escalations coming in as well. The rental prices becoming a little more stronger or increase. So there, I think over the next couple of years, we will see a little bit of positive traction. But at the same time, because of this wave that I mentioned, that the resi part was end user demand. It wasn't a bubble or a cycle, based on investors. So we believe that the resi part will also be consistent. When I say that, the cycle has turned, what it means in, again, our parlance is not prices. Do we see corrections? only in markets where there was overheating. And I'd love to give an example here so people understand. There was a product in Gurgaon where we were looking at a project where for the last 3 years it was selling at an average price of 5,500. This is a sector slightly far out. Suddenly, in 1 year, that price shot up to 8,800. Now, this is now if the price comes down from 8,800 to 7,000 or 6,500, technically it is not a crash. It
Yeah.
is still the price should have gradually moved up from 5,500 to 6,000 or 6,500 or 7,000. So those areas where there has been an overinflation of prices on the resi side is where we may see some rationalization. But overall, because of the strong demand that we're seeing across markets, we don't see prices coming down as such. There may be a time correction. So what happens is when velocity slows down, developers don't increase prices and the prices remain constant, but the income of everybody, the home buyers is going up. So what we call time correction, which is what makes it cheaper. That your ability to buy something more expensive is increasing faster than the price of the underlying real estate.
And one more question from Sanjay was that post budget, how real estate investment is sensible? Which financial products are worth investing? He has three questions. And what product? Okay, let me take the first two questions first. Post budget, how real estate investing is sensible, and second is like which financial product are worth investing?
So, like I said, right, it depends on your risk appetite. The safest is, yield, but it gives you close to fixed deposit returns. So you may not want to play that part. The higher up you go, the underlying risk increases. And if I was to explain real estate risk, it's very simple. Real estate risk is broken down into four basic parts. There's approval risk. There's title risk. There's approval risk. There's construction risk and selling risk. So if I was to draw it on a straight line, the closer you get to a ready product, the lower your risk. And the closer you are to land, the higher your risk. Because then the risk of, is this land zoned properly? Does this land, will I get approvals? Is there some issue on the land? The moment you get approvals, all of those are out. Then, in approvals, what will be my FSI? Will I be able to build A, B, C? You remove that, then you come into, oh my God, will I be able to construct? Will I face challenges? What happens if commodity prices go up, like when Russia and Ukraine happened? Suddenly, there was a massive spike for about 3 months in cost of all raw materials. Nobody knew how long that would last. So then comes last is, okay, I've made it. I can make it now. Will I be able to sell it? So the risk kind of goes, from one end of the spectrum to the other. So I think when you're investing again in the product, do not be blinded just by the return that is promised. Understand the underlying risk that the product is taking, or the gentleman or the lady running the product is taking. uh, then accordingly make investments, because if you dive in just with the lure of high returns without understanding the risk, the sector is still tricky and you will face challenges. So hence that entire blend, that where in the middle is a perfect blend, that with low risk can I get higher return, and what we would call arbitrage. And the beauty, and like I mentioned earlier, this sector gives an arbitrage of 250 to 300 bips on similar risk compared to any other sector, because of that mismatch on the higher end of or the mid range of the return category. So I think my recommendation would be that would be a better area to play real estate, uh, where it's a nice blend, and the structure is strong enough that it can withstand the cyclicality of the inherent nature of the business, and not try and be timing cycles. So that would be my advice.
So when you say the four types of risk, so even the construction has its own, diversifications or something. So if when does this Aditya Birla strategy going to step in? Is it when the developer buy the land, or is going to start the construction, or at the selling point? When do you enter into the deal?
Perfect. So we did this exercise about 8 years ago. We actually took every single investment made by all the funds institutions in the country, sat down and said, where have they actually gotten stuck? So we realized that there are certain aspects of real estate in India which are in no one's control and no fund manager can control it. For example, the time taken for approvals. Because we've had instances from the engineer is on leave, there's a wedding in the family, come back 2 months later, to, there was a time, shockingly, in Hyderabad where there was no RERA head for 6 months. And this is as recent as 2023. Uh, then no approvals were given for 6 months. So because of stuff like this, which you can't control, your risk goes up. So we as a strategy said we will only enter post approvals because the idea is to give consistent returns to our partners. Uh, Second, the other challenge that the industry saw is people love big projects. So people would do 2 million, 3 million, 4 million square foot projects. Now the time taken to construct that in India is, depending
Huge.
on the city, 7, 8, 9, 10. If it's Mumbai, it's 2 decades. And so it's a very long period where you will go through a cycle, at least one, if not two or three. So when you are designing a product, we said we want to make sure that we can look at a product which gets done in the next 3 or 4 years, because that gives us visibility. As a fund manager, we are able to see where the market, the prices, the absorption, where they are in the next 12 months, 24 months. But longer tenure, it becomes challenging because there are a lot of factors, including geopolitical factors now, that impact the sector. Third, what we realized is that this is a sector where, especially I'll give an example, time like this, when sales are very good, the developers are tempted to take the money and deploy it elsewhere, buy new land, and vice versa. Now, that is what got people into trouble the first time, and hence government came out with RERA saying that 70% of the money has to be, left for construction so that you don't divert capital and get into trouble. So I think control of the cash flows is critical. So we, as a house, make sure that we become sole signatories on all bank accounts. So we control the cash flow, because only then exactly where every rupee is going and how do you kind of extract the most out of that project. And lastly, my view that no two fund managers think the same. So right, and when I say this, I mean risk is relative. So, for example, let's say that we've got a covenant that he's supposed to sell 5 units every month. Now, what happens if he doesn't meet the covenant for 1 month, 2 months, 3 months? The documents will provide you rights, but what you end up doing is going to be very different from fund manager to fund manager to fund manager. And I think that is why one fund manager controlling the entire asset instead of there being too many
Oh,
cooks in the kitchen, as they say, I think is also very helpful, and that's what we've seen across the sector. So these are some 4 5 basics that we do, and it's yielded great results. We've been consistent in our returns. We've been able to prove to all our partners and investors that this is a sector which can deliver consistent returns, and again that higher returns with those 200 300 basis point delta over other sectors. And I think once that confidence comes into investors, I don't think there is any dearth of liquidity in this country. So we will start seeing money flowing a little bit, hopefully, from the equity side to more consistent, slightly higher yields.
so coming back to the Venn diagram now. So let's have two circles. One is for equity, and other one is for this real estate. Do you ever think this, these two circles can become a Venn diagram when there's any fluctuations in the equity market? Is there any drift towards the real estate sector? Do
So
you think there's any
uh,
correlation? That's just a very simple question.
no, no, absolutely. I think equity markets have created significant wealth. India is at a stage where it's growing. Equity markets will continue to do well. I think the art of picking winners that do better than the others is why we have expert fund managers across the industry. I think that is going to continue because India is still growing, right? If you're going to become from a 4 trillion to a 7 trillion or 10 trillion economy, I think that is going to remain. But with that also comes the inherent risk that you may not always pick winners. So equity risk is different. The return will be higher, and so will be the risk. I think what most people have forgotten in the last 3 years, because it's only been a one-sided bull run in equity, there are times when equity markets also stagnate and give lower returns than
Right.
slightly higher yield debt, right? Not your G-Secs and all, but slightly higher yield debt. So what we are seeing is, especially when people have made a large amount of gain in a short period like the last 2 3 years, people do tend to take some money out and then redeploy it to other asset classes for diversification. Real estate is one of them. Even today, psychologically, owning hard real estate gives people that comfort that I can see and touch and feel this is not going away anywhere. The markets can crash. So that's why I think that's critical, to real estate growth as well, because making decent amount of returns on equity does give people the capital to deploy in real estate. Uh, when you say will the two ever come together in terms of so in real estate, I think like any other sector, we got to look at. So there are listed guys who are giving equity returns, and real estate stocks have done exceedingly well. I think real estate, I don't know why everybody looks at it as one sector. When you say real estate, then irrespective of the product, it's irrelevant. So real estate has equity, like other sectors, which will give higher returns and will be momentum driven when the markets are doing well. And the two inherent, greed and fear is what drives the markets. And I think those always be true. That when the market crashes, everybody sells because it's fear, and when it's going up, it's greed. That no, I will make more money, and then they keep pumping in, and somebody gets burned at the peak. So I think those basic human traits will remain and continue. But the fact that the investor now has the ability to choose the risk they want is also available in the sector is the point that I was trying to reiterate over and over through this. And it is a significant sector if you look at it as its contribution to GDP, if you look at it as the employment that it provides, and it is a sector which is here to stay. It is not something that is going to be at any point in time not relevant because you need especially in a country, developing country like India. I think the requirement in terms of housing is immense. I think all our careers are going to be short, and there's still going to be a housing shortfall. So tremendous opportunity there.
Okay, one hand you're going to say that there's a housing shortfall, and other hand, due to the construction take a bit more than a time expected. Construction or developers find it difficult to sell a particular property. So, do you see that as a risk, or how do you address that point?
It is. So, a property in India will not get sold for two reasons. Either it is a wrong product for the micro market where they're selling, or it is mispriced, or it is constructed wrong. There are only three reasons why. So, let's say somebody's built a property and we face this, right? Now, none of the apartments were Vastu compliant, and this is a market in the south. It did not sell because Vastu is a big thing down south. So, which means it was not designed properly. Similarly, we've seen, forget anything else, I'll take the Mumbai example. In the Worli Lower Parel belt in 2010 to 14, everybody built these super high-end luxury ones, and now they're getting absorbed 10 years later. They're fully absorbed now because the cycle turned. For that time and for that income, some of the products were not the right time and the right I mean, eventually as incomes grew and it started being coming within the affordability part, they got absorbed, but it took a good 10 years for all of it to be absorbed, where the developers underwriting was 3 and 4 years and 5 years. So I think those are some of the reasons. Now again, somebody, for example, again not getting into the project specific project, made a extremely large 3,000 square foot houses in Mumbai, but in a far off location, and 10 crore plus ticket sizes. Now, people who have 10 crores don't want to go live in that location. So again, a wrong product for the wrong market, and had challenges selling it. So I think those aspects are also critical. It's even though there's a shortage, it doesn't mean that just because you built it, it'll get sold.
Got it. And in this space, in this real estate credit space, there are very few AMCs going to give the best product. We have a handful AMCs. So how does this Aditya Birla stand out?
So I think it comes down to the basic ethos of an organization, and Aditya Birla. I think it's very clear that we don't do things for short term profit. We are always thinking long term. The group ethos is that make sure that both our investors and our partners and us, we travel on the journey together. So wealth creation is a journey, and it's not a opportunity to be capitalized. So with that approach, when you start designing your products, start delivering your services, I think it goes a long way. The challenge in the market is that everybody loves near-term, short-term gains, and I think that is not sustainable. So again, I said I think it's more of the ethos that the group has imbibed into every single employee, and which get carried forward, and that's how we'd like to continue to operate.
Okay. And also, one last question before moving on to the my final one. One question was that when you source a deal, do you accept any co-investment, or do you want to be the only person to learn?
We are open to co-investment. So, like I said, I think our strategy is that in whichever form, because this is a sector or segment where the investors first need confidence. Once they get confidence in the ability of whichever house they're with, then there is a lot of capital waiting at the gates. So we are open to co-investment. We're open to whichever form our investors and partners get comfort to show them that these consistent returns are a very, very strong, not just a possibility, but an eventuality.
Thank you, sir. With that, we're coming to the end of the session. Let me close it with one thing, actually. If your strategy was written as a book, what would you name it as? It's a total surprise question to you, but I
Yes,
want.
I think I would call it the steepest learning curve.
Okay. Thank you, sir. Thank you for that. Thank you for your time. Of course, I had a lot of questions on the Q&A box which was not answered. So I would request, I'll be sending those questions to you via mail. I would request you to answer them and send it back to the respective people.
Perfect.
And thank you for your time, sir.
Thank you, everyone, for giving your time, and thank you, Akshat.